You're listening to the Moneyweb Now podcast series with Simon Brown. Live streamed every weekday at 6:30 a.m.
It's Thursday, 27 August. We got Harmony results due within the hour. I'm Simon Brown, coming at you live and loud from the Moneyweb Global Headquarters in Johannesburg, South Africa. On the show today, Donnie Dorfling from More Infinity. I want to touch on the Blue Label results. The first post the Cell C listing, and I got to say, core business looks okay. We'll get Donnie's view on that. And then Nvidia, which market results came out after close last night. Stocks up some 5.5% after close, so market liking that. Paul O'Flaherty from Met Air results improved performance, even as some local OEMs struggle, and that China growth hurts in the short term. And then we're going to chat with co-founder at Naked Insurance on how affordability and younger buyers is reshaping motorist choices. This podcast is brought to you by Standlib Asset Management. Invest in more global opportunities through their partnership with JP Morgan Asset Management. Morning headlines: Moneyweb, new crises at Durban Port prompts call for urgent action. Vessel delays have worsened sharply. Anchorage times rising to 7 days and berth at 5 days. Bloomberg, Meta agrees to a $16.7 billion fine to settle social media cases. And morning markets, US was mixed but hardly changed. S&P was down 0.02% and Nasdaq was up 0.05%. Easter's mixed. Sydney's off 0.5%, as is Hong Kong. Tokyo's up 0.1% and Tencent a little over 0.5% higher. Commodities mostly red. Gold futures 4,689. Brent is the green 87.27. Platinum 1,863. Palladium 1,352. The rand is 15.94. Bitcoin 78,800. And top 40 opening call. Green open expected 480 points, 0.4% higher.
Moneyweb Now on the money. Also available on podcast.
Chatting now with Donnie Dorfling from More Infinity. Donnie, appreciate the early morning time. Blue Label numbers. I mean, we've got a dividend. We've got share buybacks coming. We've got core business looking profitable. There was a lot moving within it because of the Cell C restructuring and listing. Your thoughts on Blue Label, the results and the potential going forward?
Morning, Simon and listeners, and thanks for having me. I think the 4.9 reported loss obscures the underlying result.
Yeah. Because
it's largely a non-cash accounting consequence of obtaining control over Cell C during the restructuring and then losing control when Cell C listed. That essentially produced a deconsolidation loss of roughly 6 billion, partly offset by an earlier remeasurement gain and other accounting movements. So it's obviously not a fresh 4.9 billion cash loss, but it is economically meaningful. I mean, the listing crystallized the difference between the value assembled through the restructuring and the 9 billion valuation the public market was willing to pay. So excluding Cell C, CEC, and the restructuring related items, Blue Label generated 9.4 billion of revenue, 923 million of EBITDA, and 677 million of attributable profit, and core headline earnings of 75 cents or 75.33 cents a share.
Yeah, and that's it. I mean, the core business actually looks fairly good. And I mean, there's some tweaks in terms of how they are reporting earnings and the like. And you know, is it a pin buy purchase or not? We don't need to go into that. But broadly, it's looking, you know, with Cell C kind of largely fixed, and now, you know, they still hold a stake in it. But the core Blue Label business is looking nice and profitable. Sort of back to the Blue Label of pre-Cell C days.
Yeah, absolutely. And this is probably the hardest question for management, right? Because normalized EBITDA fell from 535 million in the first half to about 387 million in the second. Management says it's a 55-45 seasonal split, which is normal, while the actual result was more closely to 58-42. Yeah. I mean, it's not wildly outside the normal pattern, but the next result needs to prove that the 923 million is a sustainable earning base. The electricity business illustrates the pressure. I mean, Blue Label processed approximately 2 billion more electricity, but commission income fell by 40 million. So the implied commission yield declined by roughly 16%. I guess the problem is not transaction value. It's about how much Blue Label earns from each transaction.
Yeah, that's a fair point. What is their margin on it? That's a fair point. Let's move on to Nvidia. Results at aftermarket close. The stock was sort of flat in the day. It's now up some 5.5%. Trading, not quite all-time highs. It revenue was up 106% year on year, and it beat 96 billion versus expected 92. Earnings per share 222, expected 208. I was looking for some wrinkles. The gross margins shrinking a bit because memory cost, but a lot to like. Your thoughts on the Nvidia number?
Yeah, it was an exceptional operating result. Revenue was 96.2 billion, up 106% year on year, with data centers contributing $89 billion of that. Adjusted earnings of $2.22 per share, a beat, obviously, expectations, and the Q3 revenue guide moves the quarterly base up again to 108 billion. What I find particularly interesting is the question around circular financing, because there's a lot of speculation in the market around this, and there's evidence that Nvidia is taking on more ecosystem risk, but that obviously does not prove the demand is fictitious. So debtors days increased from 45 to 60 because Nvidia extended terms to certain large customers on this quarter's revenue. Those additional 15 days are roughly equivalent to carrying over about $16 billion of receivables compared with the previous collection cycle. And Nvidia is also has a 279 billion of supply and capacity commitments and maximum potential guarantees of about $108 billion, although much of that is of future and contingent. So the sharp point is that Nvidia is increasingly underwriting both sides. It's committing to upstream supply while helping create the financing and infrastructure that enable downstream customers to buy its product. So if demand holds, that strengthens the moat. If it slows, it actually leaves Nvidia exposed on both sides.
Yeah, it's a risk that they're taking. And I saw an interview with Jensen Wong, and he's like, yep, you know what, he gets that, but frankly, he wishes he had started it earlier. I don't know. We'll see. Time will tell. And I suppose the point is, as you say, if things go good, this is all great and everything works. It's if it starts to wiggle. But we'll leave it there. Really appreciate the time. It's Donnie Dolfling from More Infinity, and our poll today on LinkedIn is around those Nvidia numbers. Are you a shareholder? Are you a happy shareholder? Have you missed it? Have you perhaps taken some profits? Have your vote, have your say. LinkedIn. Let your money weather the storms with Stanlib Asset Management. Invest in the Stanlib Global Select Fund, a diversified all-weather equity portfolio submanaged by JP Morgan Asset Management. The headlines tell you what's happening, but you know what it means for your money. Join Moneyweb editor Rate van Niekerk in conversation with National Treasury DG and Gina Skuman, Head of City Research South Africa, as they explain the economic forces shaping South Africa's future and your financial future. Tuesday, 1 September at the Sandton Convention Centre. Register for free using the promo code MONEYWEB. Money Summit in partnership with Moneyweb, the conversations that move markets and your money.
Moneyweb now on the money.
Staying with Paul Flaherty, CEO Mete. Results for 6 months ending June saw revenue up 1%. HEPS from continuing operations up 4%. Paul, appreciate the time. Let's start with the balance sheet. Still high debt, but looking much better. Refinancing done to, 2031. Covenants are comfortable. A starkly different balance sheet from the last couple of years, and one I imagine that you're a lot more comfortable with.
Yeah, definitely, Simon. A lot more comfortable, because we've pushed it out, and we used to have these quarterly EBITDA requirements that if we didn't meet it, we had to do some sort of corporate action. So what this gives us freedom, a lot freer opportunities as management to focus on the EBITDA and the cash flow and not have a noose around our necks. So now we can really work within the constraint that we have.
Yeah, focus on the business, a good old-fashioned.
Yeah, exactly.
AutoZone, when we chatted last, you said, look, it wasn't on schedule, but you're profitable now from May. It's late, sure, but it's now making profit and now contributing to the group.
It's contributing. We're hoping for the full year it can contribute even more. I called out that 6 to 9 months previously. So probably, starting from early next year, then you stood to see it getting back to where it once was. So totally new management team, but definitely seeing what they can do.
How's the sort of rest of the aftermarket? How's aftermarket generally? And I ask for two reasons. Obviously, it's an important part of the group, but also because the Chinese vehicles, we lose out because they're import. But now they're in the country, and as they age, they're going to need some aftermarket.
Yeah, exactly. So, we have, like I suppose all our competitors, quite sophisticated data about all the cars on the road, the car park, where they are, the age of those vehicles. We track the VIN numbers. We know the component parts. So 100% right. As you age, then we build for those vehicles or we buy for those vehicles as well. So we're on it, yeah.
I was going to say competitive. I would say that the automotive space generally is incredibly competitive. Aftermarket, I would imagine intensely so.
Oh, it's intense. I mean, they talk about a 100 billion rand market, and we've got to figure out where we operate. We don't supply every part, and we've got to figure out the regions we operate. So, very competitive. I mean, Midas is competitive, Goldwagon's competitive. So, yeah, we need to find our space. Yeah.
I hadn't realized it was that big. That's a giant industry. You're also looking to do more into the rest of the continent, and this, I imagine, will be in the aftermarket space.
Definitely in the aftermarket. We did a lot of research last year about the car parks, the regulations, what's happening in the rest of the continent. And we see our initial opportunity definitely in aftermarket. And we've appointed a team for that based on a lot of information. And now we need to make some inroads.
I imagine, maybe I'm completely wrong, but I would imagine the car park in the rest of the continent is, on average, probably older than South Africa.
Definitely older and growing. As the youth get access to vehicles as well. So it's a significant car park, yeah.
I mentioned Chinese imports. Of course, that impacts your OEM business. And the truth of the fact, there's not a lot you can do in that regard. You're beholden to customers. You mentioned you had a transition. It went smooth. You've got one of your major customers seeing strong demand for a new model. That is what you need to see on that process. You can't directly influence.
Unfortunately, we cannot influence. All we can do is look for new opportunities. For example, if Chery come in here full-time, that's an opportunity for us. Or, Stellantis were talking at some stage. But you're right, we are absolutely dependent. And that's why we went with the aftermarket strategy, so that we just don't have a total concentration for OEMs. Yeah.
You did move your OEM, the EBITDA margin, higher, 7.6 versus 7. That's a fairly chunky increase. You attribute that to efficiencies, to what you spent the last couple of years doing. Can that margin still go higher? Is there a space for more upside?
We think there's still space for the upside. Definitely, we need to get over 8 to 9% in the EBITDA margin. So, yeah, we definitely think there's space. Yeah.
There's a major review of the Automotive Production and Development Program Phase 2. I think the output is due fairly soon. Is there anything in that could potentially benefit Mete, or are you a bystander?
No, a lot could benefit us, and because we're dependent on the OEMs.
Yeah.
So will there be incentives to encourage new entrants into the market for complete knockdown as opposed to semi-knockdown? Are they going to have a look at the ad valorem, the whole incentive structure around this market and how those get used, the import duties, etc. So, yeah, we're hopeful that can be a good boost for the market.
You made a point in the results that your strategic reset largely complete, and that's perhaps best illustrated by the balance sheet we spoke up top. It really is now, I suppose, some things, for example, the review of the Automotive Production Development Program Phase 2, that can benefit. It really is now just sort of head down and growing business, improving margins, finding opportunities.
That's exactly it. That's what we focus on. We don't have any other game plan. The game plan's what you described.
Just grow the business. We'll leave it there. Paul Flaherty, CEO, Mete, appreciate the time. Give your money smoother returns for Stanlib Asset Management. The Stanlib Flexible Income Fund's agile investment process preserves and grows capital in all markets.
Moneyweb now on the money.
Chatting now with Sumri Kheba. She is co-founder at Naked Insurance. Sumri, appreciate the early morning time. You've been doing analysis of your clients, looking at young drivers under 28 from 2022-23 through to the current 25-26 years. What's changed most in what the younger drivers are driving today from your data analysis?
Good morning, Simon. It's really nice to be here this morning. And it's quite interesting. The young drivers are still going, of course, for the more affordable cars, the reliable cars. But we've definitely seen a shift in the type of vehicles that they are insuring on our insurance platform. I don't think it will be a surprise for anyone that the VWs especially the polos, are still top of the pops. But we have seen a significant shift in the sense that second is now that they're looking at the Suzukis as a very affordable option, and that's been very interesting for us.
I stop at a robot in Johannesburg, and there's going to be another Suzuki at that intersection, almost guaranteed. But it does tell us that, notwithstanding, VW is still there, but we're seeing a bit of sort of, I don't know, brand loyalty, perhaps. I don't want to say breaking. That seems a bit extreme, but certainly maybe creaking at the edges.
Yeah, definitely. But I think it is to be expected because, for example, if you look at Suzuki Swift 1.2 GL, that is 30% cheaper than your VW Polo Vivo. And I think with the financial pressures that all of us, and especially young people, are under, and given that this is like such a big asset for them to buy and such a big expense, it makes sense that loyalty shift will happen. And we're definitely seeing it happening in our data.
And that then kind of plays into my next question, which was what you do see is that they are prioritizing comprehensive insurance. This is a more expensive insurance, notwithstanding cost pressures. But I suppose there's two sides to that. There's cost pressure on your budget. Comprehensive is expensive. But as you've just said, this is a big asset that they've just bought. When you're, in your early 20s, your vehicle is much of what you own. You want to insure it. So it is that trade-off. And in many senses, the trade-off is, let's protect it.
Yeah, we were actually expecting to see more people opting for third party only, but we definitely haven't seen that. We've actually seen a slight increase because almost everyone universally go for the comprehensive cover. Yeah. But we've seen that little bit of even an increase over the last while in terms of people picking comprehensive car insurance, and that they're actually trying to use other methods to try and reduce their premium that they're paying for their comprehensive cover, like flexing their excess. So, it has really been interesting. And I think the other thing that we have been seeing is that instead of reducing cover, they've actually even been increasing cover, because we offer something called shortfall, which cover the gap between what your insurer will pay you and what your loan amount is with your bank. And we've seen actually an increase in the number of young people taking that, with 1 in 5 people with us opting to actually add that cover on, which is much higher than it was a couple of years ago.
And this is younger people, and to be clear, I'm on the other end of the age spectrum. And when I was getting insurance, when I was getting insurance in my 20s, I just took insurance. I didn't read policies or T's and C's. This is young folks saying, hang on, I can push up my excess. I can maybe drop the car hire benefit because I could Uber or something like that. And taking that shortfall cover, it's them being very smart about this insurance and working it properly, which is what they, this is what we wish for them to do.
No, it's actually really a great thing to see. And I think the younger generation think very differently about these things. Like you said, in our day, you did what your dad told you to do or your mom told you to do and didn't really think about it. But with how much education material is available online, and Naked actually has a very big drive to try and educate our customer base. We see our young customers engaging with that and actually making the right decisions, which I think is really impressive. Yeah.
No, insurance is important. Being smart about insurance is also important, and it's great to see people doing both. Absolutely. We'll leave it there. Samiri Kheba, co-founder, Naked Insurance. Appreciate the early morning time. That's it for today. We were chatting with Ahmed yesterday from GTC FX. We're talking around trading in volatile markets. The market's driven by headlines, by angry tweets, rather than perhaps fundamentals or economics. We asked you if this is a harder market for traders. Almost half said yes, it is harder, but you manage. A third was saying nope, same as always. And the rest was saying yeah, and you are taking some pain. Have your vote, have your say. LinkedIn. This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. We're live every weekday morning on the Moneyweb website and the app, 6:30 a.m. podcast just after 7. Thanks to my team, Eddie, Nobukhle, Nicole, Sabu, to you for listening, my guests for their time. My name is Simon Brown. This is Moneyweb Now. If you're loving the show, please leave us a positive rating and an awesome review in your podcatcher of choice. And we will chat again tomorrow, the real paradox of AI.
You've been listening to another Moneyweb Now podcast, posted every weekday at 7 a.m. on moneyweb.co.za. Moneyweb Now, on the money.